in the broker world, that is an extremely common. I might be talking to a broker, a listing broker, and they would say, "Oh, I've got a good deal, but it's probably only a good deal for a 1031 buyer." Well, isn't that just a funny thing to say? Like, it's just such a known thing that 1031 buyers are willing to pay a premium, that you've got, kind of a list of not so great deals that you don't even want to publicly market. But if someone's willing to overpay because they have 1031 money, well, here you go. So that's the first thing I would throw out there, is I just see people make poor decisions, or not poor decisions, just that they make the best decision they can make, but with such a finite time window.
What do you feel like is the biggest frustration when it comes to the 1031 exchange and the lack thereof options for clients or investors to either to be passive or to, not doesn't work for business sales or crypto or stock, or, walk us through what your biggest frustration for 1031 is.
Yeah, so as a licensed real estate agent and private equity fund manager, I've had a front row seat to a lot of 1031 exchanges. The first thing I would call out for anyone out there, contemplating a 1031 exchange, is that when the market is hot, there's almost an insider speak. And Brett, I'm sure you've kind of heard this before. So let's say you have a buyer and you're talking to other brokers looking for a deal, and you might say something like, "I've got a buyer with hot 1031 cash. I have a buyer who is under contract to sell, or is in that 1031 exchange window." And that almost immediately, conveys to a counterparty that my buyer is hyper motivated and willing to pay for a premium. In fact, to a certain extent, they might even be willing to, kind of take a bad deal, or a thin deal at best. So what are the things that you normally wouldn't want to show because they're not great deals? Like, my buyer is willing to take a look at it. So that's not something that most brokers are necessarily going to share with their clients, but in the broker world, that is an extremely common. I might be talking to a broker, a listing broker, and they would say, "Oh, I've got a good deal, but it's probably only a good deal for a 1031 buyer." Well, isn't that just a funny thing to say? Like, it's just such a known thing that 1031 buyers are willing to pay a premium, that you've got, kind of a list of not so great deals that you don't even want to publicly market. But if someone's willing to overpay because they have 1031 money, well, here you go. So that's the first thing I would throw out there, is I just see people make poor decisions, or not poor decisions, just that they make the best decision they can make, but with such a finite time window, like, it's difficult to make good decisions. So I would caution people about that from a 1031 perspective. You really want to do it the other way around if you can, where you're kind of hurried to sell the asset maybe instead of buy the asset, depending on market conditions and everything, and maybe make your buy contingent on you being able to successfully sell your property that you'd like to sell at a fair price that works for you. I've found people line that up very successfully in that direction, whereas they kind of get stuck when they're going in the opposite direction, because your buyer is typically the person that holds those contingencies, not the seller in that real estate sales transaction. The other thing that I'd caution people about is, I would say they're often somewhat ignorant of some of the rules associated with it. So they'll often come to me and say, "Hey, Nick, I want to do a 1031 exchange. I just sold my property." I'm like, "Okay, well, who's the intermediary you're working with?" And they'll say, "What do you mean?" And I'm like, "Okay, well, it turns out you don't have a 1031 exchange, and you don't even know it yet. As soon as you accept those funds and close on your property, you need to do some certain things." And I don't want to go into that in this podcast, but there are some points of complexity there. Another example is people reach out to me all the time and say, "Hey, I'd like to 1031 exchange into your private equity fund." So it actually is possible to do that. You can form a tenant in common structure on a property that's purchased within the private equity fund, and then let those funds let that purchase season for a few years, and then do a swap of your ownership in the tenant in common structure for for shares of ownership in the private equity fund. And it is technically feasible, but it's complex and expensive. And now you have this kind of long run maintenance, of the accounting that may or may not be more trouble than it's worth. I think you need to be doing, a $5 million deal or better to even contemplate that. But the point is, people will call all the time and say, "Okay, I'm selling my warehouse or my triple net, kind of very, very passive investment, and I want to roll that into your private equity fund, Nick, on a 1031 exchange." Well, we've tried to do it on multiple occasions. We have never once successfully, had someone enter our private equity fund on a 1031 exchange basis, just because of the complexity involved. So I think a lot of people are sometimes ignorant of some of the restrictions that can go with it. And these days, a significant portion of all the real estate out there is purchased in private equity funds, real estate syndications, in, I'm going to say just more sophisticated ownership structures that do not necessarily facilitate a 1031 exchange. And people, I would say they don't realize that. They might start out buying a single family home, and then they 1031 exchange into a duplex, and then into a 12 unit apartment building. Then they go to sell that 12 unit apartment building, and they want to go make the leap to a 100 unit apartment building. Well, you're probably doing that in a joint venture partnership, real estate syndication, private equity fund, and you're kind of stuck. You have to go find like a 24 unit apartment building, something to typically double up in your 1031 exchange, and it limits your possibilities in that kind of medium sized apartment segment. There's not a ton of those properties out there.
Yep, we couldn't agree with you more. We call that the shotgun wedding, right? And we call that selling high and buying higher 180 days later. And maybe even going into bad debt, right? Debt meaning it's 8% or 7%, and your cap rate's still at 5%. Not necessarily having the forced appreciation. It's all the reasons why people who actually got hurt in the 2008 economic crash in multifamily, because they had bad debt and they had overpaid for the 1031. That was the single, cause. If you went back and track that, I was at Marcus and Millichap selling multifamily properties, and we saw a gentleman lose $50 million worth of assets because he had overpaid. The music stopped on the 1031 musical chairs, and all of a sudden he's left with too much debt and everything going sideways. He loses everything, goes bankrupt, loses his own house. And we're going, there's got to be a better way. And there is, everybody. You can go to experttaxsecrets.com to learn more about the best 1031 exit plan. And it gives you an ability to exit, defer capital gains taxes without ever having to do a 1031 exchange ever again. You can go right into private equity, just like an LP investor, no tenant in common required. No weird accounting required. It doesn't take a deferred sales trust is the strategy we invest in, but it comes into the private equity as a seamless way, just like any other investor would. And we think it's the best kept secret. In fact, we wrote a book about it, and the book's called Building a Capital Gains Tax Exit Plan, hit #1 bestseller. And this is what we do every single day to help people understand what this is and not feel trapped by that. You can go to Amazon and check that out.